Good afternoon and welcome to this Mills Oakley webinar on DGR status, the new ruling on the In Australia requirement. I'm really grateful that you've decided to join us this afternoon, and I hope that this presentation will provide you with the guidance that you need to be able to determine whether or not your organisation is entitled to be a DGR if it's going to be sending money overseas or doing activities overseas. So the PowerPoint should be on your screen in a second, and we will ensure that after the webinar is over, we also send you a copy of the PowerPoint for your records. I invite you to ask questions. If you can please type them in and send them in, and then in the last few minutes of this webinar, I'll look at the questions and try to respond to as many as I can. Please, I encourage you to write in, and if I don't get to answer your question during the webinar, then I'll take it offline and respond to you as soon as I can after the webinar. So let's get started. So this afternoon, we'll be looking at 5 different areas. What are DGRs? I'm sure most of you know, but I think it's worthwhile covering that. What is the benefit of being a DGR? What was the law prior to this ruling coming in December last year? What does the ruling actually say? And then we're going to finish off with a bit of a summary. So let's start off with a bit of a summary of In Australia. So even though the title to the webinar was about DGRs, in actual fact, the new ruling, which is, let me see, looks like about 30 pages, no, 25 pages long, doesn't just talk about DGRs, it also talks about income tax exempt entities and refunds of franking credits. So it explains what it means to be in Australia for DGRs, for income tax exempt entities, and for refunds of franking credits. I'm going to spend most of the time today on DGRs, but I'll also cover the other two. What I want to make clear, however, is that I don't want you to think that if you satisfy the In Australia test, that you are automatically entitled to be a DGR. There are many, many other requirements, many other things you need to be aware of. So I think it's also important for me to explain to you what we're not going to be looking at this afternoon. We are not going to be looking at what sorts of donations are possible. So we're not going to be looking at donations above $2, different types of property, cars, artwork, and so on that can be donated. We're not going to be looking at the personal circumstances of the donor. So you obviously would appreciate that in order for a person to claim a tax deduction, that also depends on their own personal tax circumstances. We're not going to be looking at what is an eligible gift. There's a whole other ruling for that, which is 2005/13, which obviously has been around for 15 years. It is relatively long, but it's also important if you're operating a DGR to be aware of that ruling. That ruling talks about what sort of gifts are allowed to be tax deductible. So we're not talking about that this afternoon, but please make sure that you're aware of that. And if you have any questions about that ruling, obviously feel free to contact me. And we're also not going to be looking at all the different complex rules imposed by the tax office about running an event and what is deductible. So here I'm talking about running a charity dinner and a person buys a ticket for $200, but the actual dinner is worth $50, so they can only claim a tax deduction for $150. We're not going to go into that again. That is another set of rules. We are only looking at what is necessary to satisfy the In Australia test. So let's start with what is a DGR. A DGR is an organisation that can receive tax deductible donations. Whether or not you're a DGR is a decision made by the tax office. It is not the ACNC or any other regulator. The tax office is the only body in Australia that decides whether or not an organisation is a DGR. And just to repeat, whether or not, so if I make a donation of $1,000 to an organisation, the organisation may be a DGR, and that's fantastic. but whether or not I can claim a tax deduction also depends on my personal circumstances. If I'm not a resident of Australia, I cannot claim a tax deduction. If my income is less than $1,000, then obviously I can't claim the whole tax deduction. So please be aware when you're talking to your donors that although you may be a DGR, whether or not they can actually claim a deduction for the whole amount depends on their own personal situation. So in Australia, there are two different ways you can become a DGR. You either fit into one of the 50 plus categories of DGRs, or you're actually named in the Tax Act. So the 50 plus categories I'm talking about are PBIs, cultural organisations, scholarship funds, hospitals, what else can I think of? Environmental organisations and so on. There are 50 something categories of this. But if you cannot fit into the 50 categories, then if you want to be a DGR, you have to actually approach a member of parliament and convince them that you are so special that they should still make you a DGR, and if they do, the actual name of your organisation is mentioned in the Income Tax Assessment Act. So the ruling that came out in December, which is the ruling that I'm talking about during this webinar, applies to most of these DGRs, but not all of them. It applies to the 50-something categories. It applies to a few that are listed in the Act, but what you have to realise is that all of those have to be what we call Item 1 DGRs. Another thing you need to know, and I'm sure you do, is there are what we call Item 1 DGRs and Item 2 DGRs. Item 1 DGRs are the organisations that directly provide or are involved in directly providing services to the public. An Item 2 DGR only raises money to give to an Item 1 DGR. So typical Item 2 DGRs are PAFs, public ancillary funds or private ancillary funds. This ruling, which dictates what it means to be in Australia, only applies to Item 1 DGRs. So what you really need to do, if you're uncertain, is to go back and look into what sort of DGR your organisation is to work out, does this new ruling apply to you? What is the benefit of being a DGR? This is probably the easiest slide to explain in the whole webinar. It goes without saying, if you are a DGR, it's generally easier to fundraise because donors are more likely to make a donation if they can actually claim a tax deduction for the donation. Charities, generally, which aren't DGRs, find that a little bit harder because when they ask for a donation from the public, they can't actually, it doesn't result in a tax deduction to that donor. What was the law before December 2019? The expression in Australia before December 2019 was much more narrowly interpreted. Prior to 2016, it was even more narrowly interpreted. In 2016, some changes came in. So what we have is before 2016, very narrow, 2016 to 2019, slightly wider interpretation, and now we have the new ruling in 2019, which has widened it even further. So let's have a look at this. Before 2016, it was very, very difficult for a charity, usually a PBI, to conduct activities overseas and be a DGR. This was especially the case for PBIs that wanted to work in third world countries. Before 2016, the In Australia test required activities to primarily benefit people in Australia, so not overseas, even if indirectly it helped people overseas. So before 2016, if an organisation wanted to do relief work in third world countries and be a DGR, they generally decided on being an overseas aid fund rather than a PBI. In 2016, sorry, let me explain. Over the years, we've had many different consultations and draft papers put out by Treasury about what in Australia should mean. And so we've been waiting for this new ruling that came out in December last year for a long time. And at some points in time, with some of the drafts that came out, it was really quite frightening for DGRs if they wanted to work in Australia, sorry, outside Australia. In 2016, the ATO put out a release where basically they changed in Australia to make it wider. And the change was that an organisation had to be established in Australia. So established and operating in Australia. So suddenly in 2016, if an organisation wanted to work overseas, especially in relief work, it was much easier for them to be a PBI and much better for them to be a PBI rather than an overseas aid fund. So we saw a lot of activity around 2016, and when an organisation approached us to say, Vera, we want to actually do some charity work overseas, there was no contest. It was much easier and much better for them to be a PBI than an overseas aid fund. Firstly, because it took a much shorter period of time to get the endorsement. To become an overseas aid fund easily took at least a year. The application process was much easier. You get an FBT exemption rather than a rebate, and you were much more unrestricted in the sorts of work you could do overseas, and then the countries you could work in were also not restricted. So many, many more PBIs were then created in 2016. However, there was still talk about we need to finalise what it means to be a DGR. So they issued this ruling. So what does the ruling say? This was issued on 18th of December 2019, so a bit of a Christmas present for all of us. This is legally binding. So prior to this ruling, the test of in Australia was really just an interpretation or guidance by the tax office. It was never actually in the Act, really, and it wasn't in any ruling. So finally, they've actually issued a ruling. And this is what our webinar is about this afternoon. So this ruling interprets in Australia, as I said, for three different sorts of entities. Number one, what is the in Australia test for a DGR? Number two, what is the in Australia test to be income tax exempt as a charity or not-for-profit? And number three, it also explains what it means to be in Australia to receive refunds of franking credits. So let's start off with DGRs. So this new ruling now confirms what it means to be in Australia for a DGR. And as a consequence of the ruling, the in Australia test is now much more concerned with the location of the organisation instead of where its assets are, where its transactions are, or where its activities are. So it is much wider. So this is the crux of the webinar, right? If you wish to be, or you want to maintain your DGR status, to satisfy the in Australia test, you have to satisfy two different requirements, and you have to satisfy both of them, right? They're not multiple choice. Number one, you have to be established or legally recognised in Australia, and number two, you have to make operational or strategic decisions mainly in Australia. So let's break this down. These are the two requirements for DGR, so let's read them out again. Number one, the organisation must be established or legally recognised in Australia, and so we've got two requirements you have to satisfy. Number two, the organisation must make operational or strategic decisions mainly in Australia. So you can either make operational decisions or you can make strategic decisions, and they have to be mainly in Australia, not solely in Australia, mainly in Australia. So let's look at requirement one. Requirement one, just to repeat, says that your organisation has to be established or legally recognised in Australia. What does that mean? So I've given you a list there. To be registered in Australia means either you're a charity registered with the ACNC, so that will do, or you're a company registered with ASIC, or you have an ABN, or you're an incorporated association registered, say, in New South Wales with fair trading. So here are some examples. If you can tick off on any of those, then bang, you have satisfied requirement number one. So it's relatively easy to satisfy. Requirement two is a little bit different. Requirement two depends on whether you are a fund or an authority or an institution. So we're going to go through each of these. So let's start looking at these. Every not-for-profit in Australia is either a fund or an authority or an institution. So let me explain to you what each of these are and how the two requirements apply to be a DGR. So let's look at firstly funds. Now, you would have heard of a fund. There's no technical meaning. It really means that it's basically a bank account. It's an account that holds some money which has been set aside for a particular purpose, which is usually charitable. Let me give you some examples. A scholarship fund, a necessitous circumstances fund. If you are registered as an environmental organisation, you have to have a fund. If you are registered as a cultural organisation, you have to have a fund. So some DGR categories, and I'll go back to the 50 plus categories, some of them have a requirement to operate a fund. It's a special bank account into which you put all the money that you have received as donations and all the money you've earned on those donations, say interest in a bank account. That is generally kept aside in a separate fund, and that's what we mean here in this particular slide. Sorry, these slides keep running around. Right, so to satisfy requirement one, the fund has to be established by will or trust, which is settled in Australia. That means actually signed and set up in Australia. Or you can have a fund that's actually operated by another entity, and that entity is recognised in Australia. So let me give you an example. You can have a charity which does a number of things, and one of the things it does is promote culture. And it goes and sets up a fund, and the fund is then registered on the Register of Cultural Organisations. So the entity is the charity, so say it's a public company limited by guarantee, but it also runs the fund. If the charity is registered with the ACNC, then that is enough for the fund, the cultural fund, to satisfy this condition. Or, as I've said before, another possibility is having an ABN or registering as a charity. Requirement number 2, how does that apply to funds? In order to satisfy this requirement, the fund has to have its decision-making powers about either operational or strategic matters actually conducted in Australia. So you don't have to have both operational and strategic, it's operational or strategic, and I emphasise again, it says mainly exercised, not solely exercised. You do not have to have your purposes conducted in Australia or your beneficiaries located in Australia. What the tax office is looking at is really where are the decisions made. So really, in a nutshell, we're looking at where is the board making its decisions. So here's an example which I think explains very well how the test actually is applied to a fund, and this is from straight out of the ruling. So the Cambodian Education Society is a not-for-profit organisation in Australia, registered as a charity with the ACNC. It was established by a trust which was settled in Australia. It is a public fund, so basically a bank account set up solely for the purposes of providing money, and usually funds only provide money. They don't actually do any work themselves. They raise money and then they distribute the money. So this fund provides money for the construction of a building to be used by the society as a school for disadvantaged children in Cambodia. So now let's now look at how it satisfies the two requirements to be in Australia. The trustee, because it's a trust, the trustee of the fund is a company and its directors manage the company in Australia. The trustee has a bank account in Australia and receives donations from members of the Australian public and from ancillary funds. The monies received are held by the trustee in accordance with the terms of the trust deed. Now, the conclusion by the tax office is that this public fund meets the DGR in Australia condition as it is established and legally recognised in Australia. Why? Because the trust was established in Australia and the trustee is also a company registered in Australia. Further, to satisfy requirement number 2, it's managed by way of decisions made in Australia. Now, this is a critical thing. It doesn't matter that the fund has purposes and beneficiaries located in Cambodia. It has no purposes in Australia, has no beneficiaries in Australia, they're all overseas, and yet it nevertheless satisfies the in Australia test for DGRs. Let's move on to the second type of organisation, which is an authority. The definition of authority is an agency or instrument of government that carries out a function in the public interest. It is usually satisfied by virtue of the fact that it is established by a state or territory government. So it's quite easy for an authority to satisfy both tests because it is recognised in Australia because it's set up by the Australian government, and it's has its decisions made in Australia because obviously the organisation set up by the Australian government is in Australia. Let's look at another example from the tax ruling. The Southern Abalone Authority is established by a state government to manage the abalone fishery in parts of the state. The SAA engages in research and development and investment on mitigating abalone-related diseases. The SAA funds its activities from research donations, grants, commercial licenses and policing fines. So it's an Australian government agency. It was set up by a state government. It satisfies the DGR in Australia condition as it is established by a state government in Australia. So it's got that legal recognition in Australia, and it executes a function in the public interest in Australia. The decisions are made in Australia. So it easily satisfies the two requirements of the in Australia test. Let's move on to the last one. Now, the last one is institutions, and I think most of your DGRs would be institutions. What is an institution? And the easiest way to really explain this is to compare it with a fund. I said to you a few slides ago, a fund is basically a bank account. People make donations into the fund, and then the people operating the fund decide how to spend that money. It is different from an institution. An institution actually conducts activities for the benefit of someone else. It's not just writing checks or distributing money. It's actually out meeting people, helping people. It's actually conducting those activities and achieving a not-for-profit or charitable purpose. So let's look at the two requirements. Requirement number one, the institution must have registration in Australia. And I've explained that this means either registered with the ACNC or having an ABN or registered as a company or any other type of registration. Requirement number two, we need to look at where are the decision-making powers mainly exercised. And here I'm usually talking about the board or the governing committee. And as I've said before, when looking at the decision-making powers, you can either look at purely operational or purely strategic. It doesn't have to be both, which makes it easier for you. So let's look at an example again from the ruling. The Neuromuscular Disease Foundation Australia is a company limited by guarantee. Now, automatically that should mean that it satisfies the first requirement because it is registered with ASIC. It's also registered as a health promotion charity by the ACNC, so again, it satisfies that first requirement. The NDFA has a charitable purpose of promoting the prevention of neuromuscular disease by raising public awareness of the disease and its causes. It's got sibling organisations in other countries, the UK, USA and Canada, and it works closely with a UK entity which acts on behalf of the other organisations. Now here it gets a little bit tricky. Most of the directors of the NDFA are ordinarily located in the UK, so not in Australia. The minority are based in Australia. Key strategic decisions concerning the NDFA are made at board meetings that are held twice a year by video conferencing, so it's not even physically happening in Australia. Each director has an equal vote. The activities require active day-to-day management. The Australian directors perform this function from an office in Sydney. Those directors apply their independent judgment to ensure the effective operation of the institution in accordance with the guidelines and decisions of the entire board. And as I've said, most of the board is in the UK. So let's look at, could this be a DGR in Australia? The tax office has said that this organisation would satisfy the in Australia condition. It is established and legally recognised in Australia, both under the Corporations Act as a company and the ACNC Act as a registered charity. So that is requirement number one. The NDFA also makes operational decisions in Australia, since the decision-making powers regarding operational matters are exercised in Australia. So it has satisfied requirement number two. If you go back to the previous slide, in the second point, it talked about strategic decisions. Now you'll see there, strategic decisions were made by video conferencing where most of the directors were in the UK. So it would have been very hard to satisfy that second requirement for strategic decisions. But because the small contingent of Australian directors nevertheless made operational decisions in Sydney for the activities in Australia, it is based on those operational decisions that the tax office has declared that this organisation would satisfy the test. So we finished with DGRs. Let's move on to income tax exempt entities and what the tax ruling has to say about in Australia. This is a different test. It's different from the DGR test that I just explained to you. This test for income tax exempt entities has two limbs, again, both of which have to be satisfied. The first one is the physical presence in Australia. The second one is they have to incur expenditure and pursue their objectives principally in Australia. As I've said, different from the DGR test and harder to satisfy than the DGR test. Here we've listed all the different income tax exempt entities in Australia. So if you fit into any one of these categories, you would be income tax exempt and you would have to satisfy the in Australia test. We start off with registered charities. Obviously they're income tax exempt. If you're not a registered charity and you're just a not-for-profit, then you have to satisfy the conditions attached to the other 1, 2, 3, 4, 5, 6, 7 categories. So if you're not in any of these categories, you would not be income tax exempt and you would not have to be concerned about the in Australia test. So let's look at the in Australia test as defined in this new ruling. The first one is the physical presence test. To be income tax exempt, you have to have a physical presence in Australia. This is satisfied if you employ assets or people to conduct your physical operations in Australia. So to explain further, you can be legally established in Australia or conduct your operations in Australia through a division, subdivision or branch. So what does that mean? You can either be set up as a separate entity in Australia, typically as a public company limited by guarantee, a trust or an incorporated association, or if your main headquarters are overseas, but the overseas entity has set up a division, subdivision or branch in Australia, then that division, subdivision or branch will satisfy this test. It is not enough to only have an agent in Australia. Some overseas entities, when they want to set up in Australia, they appoint an individual in Australia to be their agent, who then obviously is the main contact person in Australia. That is not enough. You've actually got to have some sort of physical presence, which means you've got to have at least, well, more than one person. You've got to have a group of people who at least represent a division, subdivision or branch in Australia. Requirement number 2, you must incur your expenditure and, so it's not or, it's and pursue your objectives principally in Australia. If you are partly operating in Australia and partly overseas, then focus on the Australian portion of the activities and silo that off and look at that in isolation and see whether that portion satisfies the in Australia test. What do we mean by principally? More than 50%. What does it mean to incur expenditure? Because you have to principally incur your expenditure in Australia. It means pay out money or have a liability to pay out money. There's got to be some connection between making the decision in Australia to pay the money and then paying that money out of an Australian source, such as a bank account. What does it mean to principally pursue your objectives in Australia, which you also have to satisfy? You need to look at where you are realising or fulfilling your purposes. If you are a fund, which means you're paying out money, are you making those distributions from an Australian source, so from an Australian bank account in Australia? If you're an institution actually conducting activities, which basically means providing some sort of good or service, are you providing those goods and services in or from Australia? Now, in working out this concept of principally the 50% rule, there are certain amounts of money that you need to disregard. And I'm going to give you an example. So if you get lost in the next couple of slides, hang in there with me, because I believe the example will make it very clear. When you're working out if you satisfy the 50%, you ignore all the money that you have received as a gift, all the money you've received as a government grant, and all the money you have received from a DGR that you actually operate. If you distribute any money that you have received from a gift, a government grant, or a DGR that you operate, you ignore that when working out the 50%. What do we mean by a gift? It just means your normal concept of a gift, such as a donation or money that you've raised from fundraising events such as raffles and dinners and so on. What do I mean by government grant? It means money that you receive from the government, regardless of whether or not the government said you've only got to spend that money on a particular purpose. But it can't be it's got to be a grant. A grant means a donation of sorts. It can't be money that the government's paying you to provide a service. So if you think of, for example, NDIS, where NDIA actually pays money, that is a fee for service. So that's not included. But if the government gives you a grant of, say, whatever it is, $10,000 to conduct research, then that can be disregarded and working out the 50%. What is not disregarded is money you receive from commercial activities, such as, say you run a conference and you charge a fee to attend. You can't include that as a disregarded amount. Say you get paid a sponsorship fee, that is not a disregarded amount. So it's only gifts, government grants, and money you receive from a DGR you operate. So let's look at this example from the ruling. This goes for 3 or 4 slides, but I think it very clearly explains how the disregarded amounts work. And I think that it's worth getting your head around this, because by applying the disregarded amounts, I'm telling you, it's much, much easier to satisfy the 50% principally test. So let's look at this example. The Vandelay Association is a charitable performing arts company established for the purpose of promoting Australian ballet. It's a registered charity with the ACNC, and it operates a fund listed on the Register of Cultural Organisations. The fund is known as the Vandelay Cultural Development Fund. So we have a charity which promotes ballet. Ballet is culture. So the charity went to the, forgotten the full name, the Department of Arts, and got approved as a registered cultural organisation. So it actually runs a fund, which we now know is a bank account of sorts, and into the fund are deposited donations made by the public. So it's a charity which runs a DGR fund. So while Vandelay can disregard amounts it receives from that fund, so say the fund gets $100,000 in donations, you don't include that when working out the 50%. It doesn't automatically satisfy the income tax exemption in Australia condition just because it operates the DGR fund. In order to satisfy the income tax exemption in Australia condition, it must look at its expenditure, it must look at where it pursues its objectives as they relate to its physical presence in Australia. So let's look at some very simple numbers. Vandelay keeps records that clearly indicate the sources of its income and how it uses the funds. In the 2019 income year, Vandelay's income of $150,000 was comprised of the following. So investments of $13,000, performance fees of $50,000. So this is obviously money that people pay to see a performance of ballet. Distributions from the DGR fund of $75,000 and a conditional government grant of $12,000. The grant is provided on the condition that the funds are spent only on ballet performances occurring in Australia, which is interesting. In that same year, this is how Vandelay spent its money. It made a distribution of $87,000 to a performing arts company in China, so not in Australia. For the remaining 53, so remember we started for the 150, right? It spent 87 overseas. For the remaining 53, sorry, it spent not 150, it spent I'll work that out. Of the remaining 53, it spent on organising performances in Australia. There we go, and it had 10,000 left in reserve. So let me clarify. It received 150. It spent 87 plus 53, which to do my math is 140, and then it had 10,000 left over, which it held in reserve. The 53,000 amount includes 3,000, which was spent on sending a performer on a 10-day intensive training course in Asia in preparation for Australian performances. So even in the 53,000 is spent on performances in Australia, of that 3,000 was spent sending someone overseas on a training course. So it really only spent 50,000 in Australia, one could argue. So Vandelay's use of funds for that year is summarised as follows. 87,000 sent to China, which is 58%, so obviously more than 50%, which is the principally test. It spent 53,000 on Australian performances, that's 35%, and reserves of 10,000, which is 7%. So in determining where its expenditure is incurred and its objectives are pursued, Vandelay can disregard the 75,000 of the 87,000 offshore distribution, 75,000 being the amount it received from its DGR fund, because remember, that's a disregarded amount, right? So therefore, only $12,000 in expenditure, 18% would reflect the pursuit of objectives outside of Australia. So technically 87,000 was spent overseas, but if you deduct from that the 75,000 it got from its DGR fund, which we know is a disregarded amount, then the ATO is saying they only really spent $12,000 overseas. So it's not what used to be 58% overseas, it's now only 18%. The remaining 53,000 expenditure, 82% of total expenditure, would reflect the pursuit of objectives in Australia, even though that includes sending one of the dancers overseas to do some training. So in the absence of further information, the ATO is saying that Vandelay would satisfy the in Australia test of incurring its expenditure and pursuing its objectives principally in Australia. And it does that by virtue of disregarding the money that it received through the DGR fund. One final comment here, and this is something that's new in the ruling. If you are a DGR and you are income tax exempt, and I've said to you before, the DGR in Australia test is much easier to satisfy than the income tax exempt in Australia test. And the ruling is saying, if you satisfy the easier test, the DGR test, then it's automatically assumed that you satisfy the income tax exemption in Australia test. So by satisfying one, they say that you're automatically satisfying the other, which again makes it easier for you. You don't need to try to establish that you satisfy both tests. Now, the third thing that the ruling talks about, which I mentioned before, is the refund of franking credits. I've got here the two elements of the in Australia test for the refund of franking credits. You'll see that they're exactly the same as the test for income tax exempt entities, so I won't explain all that all over again. The same test applies. So if you're a registered charity or a DGR, you are entitled to a refund of franking credits if you satisfy those two limbs of the in Australia test, which is the same as the income tax exempt in Australia test. So let us conclude, and then we're going to open up to some questions. In summary, we now have a new ruling. The new ruling finally explains in a legally binding fashion what it means to be in Australia to be a DGR, what it means to be in Australia to be income tax exempt, and what it means to be in Australia to be able to see refunds of franking credits. The DGR test is the easiest to satisfy. The in Australia test for income tax exempt entities and refunds of franking credits is somewhat harder to satisfy. But the benefit of the ruling is that we finally have some clarity around all three of those tests, so there's less confusion, hopefully. Plus, it says, as I mentioned a couple of slides ago, if you satisfy the DGR test, then automatically you satisfy the other two tests. Now, just a brief list of things that are on the horizon for DGR, some reforms that have been discussed now for a long, long time, and there has been some confusion as to whether they're still going ahead and when they're going to go ahead. So I've listed them there for you. They are still going to happen. The first one is non-government DGRs will have to register as charities with the ACNC or be operated by a registered charity. Obviously, government DGRs can't register because you can't be run by the government and a charity. So all non-government DGRs will automatically go across to the ACNC and the ACNC will then review them all. The second one is the 4 DGR registers currently administered by government departments will be now run by the ACNC to abolish duplicate reporting. The 4 registers are, off the top of my head, cultural organisations, environmental organisations, harm prevention organisations, and overseas aid funds. Number 3, certain public fund requirements will be abolished. What do we mean here? Currently for DGR is endorsed in 2 categories, both of which require a public fund to be maintained. At the moment have to run 2 public funds. The purpose of the reform is that it'll be possible to maintain only one public fund for both endorsements. That is a single bank account and a single governing document, so long as it can separately account for the funds for each of the DGR endorsements. So that'll be a relief. Next thing, men's and women's sheds will be eligible for DGR status. And finally, organisations promoting Indigenous languages are now also eligible for DGR status. We spoke to Treasury this morning about the status of these reforms. They said they're still happening, but obviously with COVID-19 there's been delays. It's looking as if those will come into force in the second half of this calendar year. And finally, one last comment before we move to questions. You would have heard that the ACNC has now started a formal review of charities. They've decided they're going to start with PBIs. They're going to formally review around 500 PBIs, which are registered with them as charities. They're going to select the 500 based on what they think is some sort of unusual characteristic about the charity or something they've picked up in the AIS. This should have already started, or was about to start in a few weeks. That again has been delayed by COVID-19, and the ACNC, the latest we've heard, is that these 500 PBIs will hear from the ACNC will be at the end of August 2020. All right, so now we've got about 15 minutes. We're going to move across to questions. So what questions do we have, Ariane?
So we have one question from Ian. I think this question will depend. We might need a bit more context for it. If a merger occurs with one association that isn't a DGR, can the other claim? I would assume that the other association has got DGR status.
If you're looking at merging two organisations and one has DGR and one doesn't, you've then got to carry out an assessment of what the merged organisation is going to look like. So the combination of all the employees, the assets, the funds and so on, and conduct an analysis of that organisation to see whether that will satisfy the DGR test. What you also have to think about is, if you say organisation A is a DGR and organisation B isn't, if you merge B into A and the remaining entity is A, then technically it will be registered as a DGR because the entity A always has been a DGR, but you should, for the purpose of prudence, you should actually carry out an analysis to see whether merged entity A is really still entitled to be a DGR or not, in case you get audited by the tax office or the ACNC. If you're doing the opposite, if you're merging entity A, which is a DGR, into entity B, which is not, well, then you'll stop being a DGR, obviously, and then you'll have to carry out an analysis of can entity B become a DGR and do a fresh application for it.
And just one more question from Ian. How particular is the ACNC with checking DGR status?
Not very. They're more interested in whether or not you're eligible to be a charity. So at the moment, the ACNC does not actually give DGR endorsements, apart from PBIs and health promotion charities. It's the ATO. So the two authorities, it's really the ATO that's more interested in whether or not you actually satisfy the DGR test. In terms of in Australia, that's going to be something that the ATO is much more interested in than the ACNC. All right, any other questions?
Is this webinar recorded?
That's a good question. I will have to find out. I'll definitely send you the paper and I'll find out whether it's been recorded, and if it is, we'll send it to you. Any other questions? Have I confused you all, or it makes sense? I'm hoping it makes sense. I'm hoping, if nothing else, that the tax ruling has given you some clarity around the extent to which you can do things overseas, and gives you some hope, because it'll now be much easier to do things overseas than what it was before December 2019. Oh, here we go, we've got something else.
Yeah, I'm not too sure if this will be answerable just now, but can we rely on this ruling for determining eligibility for the JobKeeper payments, which requires a NFP charity to pursue its objectives principally in Australia?
I don't know whether the legislation for JobKeeper references this particular tax ruling. we haven't seen any reference to this tax ruling. So at this point, I would say no. I would think that if they gave you a hard time about the JobKeeper payments, you should at least come forward with the fact that you satisfy this particular tax ruling. It may help you in your arguments, but we've seen no connection yet between this tax ruling and the JobKeeper legislation. No other questions? All right, well, I thank you for participating. If you think of any other questions, then by all means feel free to email me. You've got my details there. As I said, we'll email out the PowerPoint to you. We'll look into the recording of it, and I'm hoping that it's been beneficial to you to give up your hour and listen to this titillating subject of tax rulings and DGR. So thank you very much and goodbye.